Today we will dive into the land of business development companies, or BDCs. A BDC offers small and medium-sized companies capital so that they can keep growing their business and becoming more profitable. They may also help distressed companies regain some financial footing. BDCs use leverage, which makes them a risky investment, but with great risk comes great reward, as the company that we're going to be taking a look at today has a mind-boggling starting dividend yield of 10%. Ares Capital, ticker symbol ARCC, it's a different type of ARC. Let's make sure we're on the same page here, as I learned that there's several similarly named companies and tickers, but the company that we're looking at today is spelled ARES and the ticker is ARCC. Anyway, their main investment objective is to generate both current income and capital appreciation through debt and equity investments. If you've ever seen the TV show Shark Tank, a bunch of entrepreneurs try to get the sharks who have plenty of money to invest in their company or business idea. Ares follows a similar business model, except they don't have a Barbara, so there's no one to just say they're out right away. Smaller to mid-sized companies may find it hard to get loans from banks, so Ares provides the financing needs of private middle-market companies across a wide range of industries. The members of Ares Investment Committee have on average 28 years of experience. And this committee will be looking for private companies that have a history of stable cash flows, possible competitive advantages, growth prospects, and strong management teams. It's pretty amazing that we can give our money to a company that then gives that money to another company in the hopes of making more money. Some financial inception going on, but this is our chance to get exposure to professionals doing all the work of vetting these companies for us. Additionally, we get to enjoy the returns from these companies as well. In return for getting capital from Ares, the private company pays back loans with interest. They might even pay their own dividends as well. Ares may also receive a royalty, and sometimes Ares may even get capital gains from profiting off the equity. This is exactly what the sharks in Shark Tank get, and you too can now be a shark while the market is down. Let's take a look at what Ares' portfolio consists of, because they do a really great job of being transparent. First of all, they're very diversified in where they're located across the US. 35% of their portfolio is in the West Coast, the Midwest gets 25% of their business, Southeast at 18%, and they also have 5% of international exposure. They're also really diversified in the sectors that it invests in, so we have software services at 23%, healthcare at 10%, Ivy Hill Asset Management. This is basically an investment advisory services company that advises banks, institutions, insurance companies, private pensions, and that represents 10% of their portfolio. They also have many other profitable sectors in here like insurance and food and beverage, all sectors that make plenty of money. They're also super transparent in their holdings. They have 9 pages worth of information showing each company they're invested in, the company name, a business description, where they're found, what type of loan it is, and whether or not they actually hold equity in them as well. So maybe we just want to do a quick audit of one of the holdings that they claim that they have ownership in. So we have Electro Rent Corporation here. They are located on the West Coast. They're affiliated with Capital Goods and they provide test and measurement equipment. So if we do a quick Google search, we see a Wikipedia page. That's always a good sign, right? You know you're legit when you get a Wikipedia page. And then if we go on their actual website, we get some interesting graphics. But at the end of the day, we can see that Electro Rent, despite sounding like it should be a real estate company, they actually have plenty of test equipment. So this matches exactly what they claim they are investing in. And you can do this with any of the other companies that Ares Capital invests in. They have 9 pages worth, so you can see exactly what they pool their money into. Now remember I told you BDCs are typically a little bit more riskier since they involve debt. So pay attention to this next part. If a company were to go bankrupt, not all debt is created equal. Without going all Better Call Saul on you with legal jargon, when a company files for bankruptcy, there is legal rights for who gets paid back first from any assets that the company might have when they get liquidated. Those that have first lien debt get priority repayment before others. Now, that doesn't guarantee there will always be money to get repaid back. I mean, just ask FTX how that's going. So seeing over 60% of their debt be first or second lien, that's definitely a good sign to me. All right, let's talk about what's most important to you, and that's whether or not it's actually Aries season. Your girlfriend actually just informed me that it's actually Sagittarius season, which means this investment is just not compatible. But the dividends are showing a rising sign. They're showing a sign that there's really juicy dividends that Aries Capital is paying out. They're currently at a 10% starting yield. Now, Aries, they don't pay out every single month, but they do pay dividends every single quarter. So that's every March, June, September, December tranche. They sometimes even pay out an additional dividend of a few pennies, which is typically just some capital gains. Now, one of the benefits of being a BDC is if they invest 70% of their assets in private, non-public US firms worth less than $250 million, these companies can actually avoid paying corporate taxes if they distribute most of their earnings to shareholders. So it's going to be the shareholder who pays the bulk of those taxes. So unfortunately, most of the BDC distributions are going to be ordinary income, which is non-qualified dividends. So expect to be paying on your highest income tax bracket on these distributions, unless of course they're being held in a tax advantage account. Some good news here though is that Aries has an amazing track record of paying out dividends. Since they became a public company in 2004, they have paid a quarterly dividend with no interruptions. This means even though the company is in a risky sector, they continue to pay out dividends during the 2008 financial crisis when so many other bigger market cap companies, they failed to do so. They also paid out dividends during the pandemic, proving that they return profits to shareholders regardless of the economic conditions. And that's going to be important since Aries, they don't really have much capital appreciation. They're up just 27% in 18 years. Luckily, when you're returning 10% in dividends each year, that's not too big of a problem. And while it's great to see companies increase their dividend each year, Aries unfortunately does not do that. In fact, there's been very little growth with their dividend. Over the past 18 years, it's always hovered in the ballpark of 40 cents with very few exceptions. Aries remains super popular among analysts, people whose career it is to analyze the ins and outs of the company. All 8 currently believe this company is a buy. That is a 100% approval rating with a consensus price target 8% higher than today's prices. Aries Capital is certainly not your ordinary company, so we shouldn't expect it to behave like one. It's a great way to get access to smaller private companies and get some really high returns. Just know the sector is typically a riskier investment area, and dividends, they are never guaranteed. Now, I'd love to hear if you own any BDCs. If you like this content, please be sure to help out a small-time YouTuber by hitting that like button and subscribing to the channel. I'm always covering all topics related to investing. My videos are always found in podcast form under the Collect Cash podcast name.
I'm out.